ለመማር ወደ ትምህርት ተቋም መሄድ ግድ አይደለም።
ናሽናል አቪዬሽን ኮሌጅ
ራሳችሁን ከኮሮና ቫይረስ ወረርሽኝ እየጠበቃችሁ በቤታችሁ ወይም በተመቻችሁ ቦታ
በኢንተርኔት አማካኝነት በኦንላይን ትምህርታችሁን መከታተል ይቻላል።
ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና
ከእንግሊዙ ኢንስቲትዩት ኦፍ ኮመርሻል ማኔጅመንት ICM ጋር በመተባበር የሚሰጡ ትምህርቶችን ተከታትላችሁ በ6 ወር ጊዜ በዓለም አቀፍ ደረጃ ተቀባይነት ያለውን የስልጠና ማስረጃ ባለቤት መሆን ይቻላል።
ከኢትዮጵያ ሲቪል አቪዬሽን ባለስልጣን ሙሉ ዕውቅና ባገኘንባቸው የፍላይት ኦፕሬሽን እና የሆስተስ ስልጠናም በምዝገባ ላይ ነን።
ጥያቄና መልስ፣ የክፍል ስራዎች ብሎም ፈተና መፈተን ክፍል ውስጥ እንዳላችሁ አይነት
ልምድ ባላቸው መምህራን እየተማራችሁ
በኦንላይን ባላችሁበት ቦታ።
አድራሻ ከ22 ማዞሪያ ወደ ሾላ ገበያ በሚወስደው መንገድ 150 ሜትር ገባ ብሎ ናሽናል አቪዬሽን ኮሌጅ
የናሽናል ኤርዌይስ እህት ኩባንያ
ህልሞን እውን ያደርጋል።
Hello, good afternoon.
Good afternoon, Doctor.
Good afternoon, Doctor.
How are you?
Fine, Doctor.
Good. Welcome again to this class. I sent you whatever we want to discuss today, and you recall last week we introduced CVP analysis, cost, volume, profit analysis, and we said it's a very important tool for managers in decision making about meeting the targets in collaboration with the budgets and all that, so that we are able to make our targeted profit or achieve our targeted sales or try to minimize costs as much as we can. So we looked at a number of issues. One, how to determine the contribution margin. And contribution margin, we said, is the difference between selling price and variable cost. If you're looking at it from the unit point of view, so is the selling price per unit minus the variable cost per unit. It will give you the contribution margin. But using the same, we can also determine the contribution margin ratio by taking the contribution margin over the selling price times 100 to get our contribution margin ratio. Now, contribution margin is very important because it shows, variable cost, we say, changes with the level of output. So you produce more, you incur more of the variable cost. And therefore, it is likely to affect selling price more than the fixed costs, because fixed costs do not change. Those are, in other words, you are saying those are irrelevant costs that are not relevant for decision making. So we basically use the variable costs because those are the ones which are likely to change with the level of output that you are producing. So the difference between selling price and the variable cost is the contribution margin. We also talked about the break-even analysis, and break-even analysis is the point at which we are making no profit or we are making no loss. All right. So revenue is equals to cost, and revenue is equals to cost. We can also determine that level so that we know out of our sales, we have to meet a certain level of sales for us to recover our costs. And that's why a break-even point is a very important item in the decision making by managers. and it's determined by taking the fixed cost over the variable, the contribution margin. Fixed cost over the contribution margin. Now, there is also the margin of safety item, which we said is the difference between our sales output and the break-even point. So it represents actually the profit, but sometimes we may not achieve our target sales, but whatever we can anticipate in advance our target sales, and when we compare our target sales and the break-even point, the difference represents the margin of safety. That is the time when you can even play around with your selling price. You can reduce your selling price so that you sell more, all right? But at the same time, reducing the selling price does not mean that you are going below the cost. You're still absorbing all your costs, but you are just reducing the selling price so that you are playing within the margin of safety levels. You are playing within the margin of safety levels. So you're not just going below the cost, but you're just trying to reduce selling price so you attract more clients, and by that you sell more. So those are some of the strategies managers can use to boost up their total sales revenue. Now, we looked at an illustration last time, and it was just one, but I thought we need to look at many more, and then we see how much we can appreciate this tool as a tool for analysis and for decision making by managers. And so today I want us to just look at a few illustrations just to see how we can apply this model. And as much as we are doing this, try to relate the kind of decisions that you can make. Like if we know our break-even point is this, so what? We have to strive and make sure that we break even, and then now any extra sales that we make, we are now making our profits. All right, so that's the understanding of break-even point. We can also make decisions like reducing the selling price so that we sell more. So long as we are beyond the break-even point, we can play around with that, which is the margin of safety. Margin of safety, we make sure that we are playing within the margin of safety and not below the margin of safety. So that is also good. And those are decisions that you can make as a manager. And we said, another thing we said is that the assumptions, based on the assumptions of this tool or this model, we have to play around with these variables within a relevant range of time, in a short-term basis, not a long-term basis, because we are assuming that the variables remain constant within that range and therefore cannot change. But in the long run, they are bound to change, all right? Because as more as you continue producing and selling, the more cost you are likely to incur, and even the fixed costs are likely also to change. All right, so before I go to the illustrations, is there any question from our last discussions? Okay, I'm ready to receive any comments, questions, and then if there's none, then we can go straight away to more illustrations as I had sent you yesterday. Any questions, comments? Questions, comments? Okay, so let me take you now directly to the to the hello. Hello?
Yes, doctor.
Hello?
We can hear you. Go on. Thank
Yeah,
you.
okay, okay. Thank you. So this is one of the illustrations I wanted us to discuss today, CVP analysis illustrations. Now, these are some of the questions that probably, or some of the scenarios that you would expect as a manager to make a decision. For example, given the following information, the present production and sales is 8,000 units. The selling price per unit. I hope you're able to see the screen. Are you seeing the screen?
Yes, doctor. Yes, doctor.
All right. So selling price per unit is 20. Direct labor per unit is 2.5. Variable overhead is 100% of direct labor cost. Direct costs at $5, and then fixed costs at $40,000. Then you are required to determine the contribution margin ratio, the sales required to break-even point, and the margin of safety. Okay, so we've been given the data here, we want to achieve 8,000 units. Our selling price is 20. Our direct labor cost is 2.5. And then the variable overhead or variable cost is 100% of direct labor. And then our direct material cost is $5, could be per kg or something like that. Then fixed cost is $40,000. So the contribution margin ratio, the sales to break even, that is the break even point, and then the margin of safety. Now I will take you to the whiteboard. So that we can be able to follow this. So we are asked to determine the contribution margin ratio. And we know contribution margin ratio is equals to contribution margin over selling price. We discussed this last week. And then times 100. So our contribution margin is equals to selling price minus variable cost per unit. Now we need to determine our variable cost. Variable cost is equals to direct labor cost. Direct labor cost is a variable cost. So it is, we are given as 2.5. And then the variable overheads, we're told they are 100% of direct labor. So it means they're also 2.5. 100% is of 2.5 is still 2.5. Then our direct labor cost, direct material cost is 5. Okay. So when you add this, we get our total variable cost per unit, and that gives us what? 10, right?
Yeah.
$10. We are just adding this to get our total variable cost. Now, our selling price we know is 20. Our selling price is 20. Therefore, our contribution margin is equals to its margin, not ratio. Our contribution margin is equals to 20 minus 10. 10 is our variable cost, which gives us 10. Therefore, the ratio is 10 over selling price, which is 20, times 100. And that gives us 50%. Yes. So that gives us 50%. That is our contribution margin ratio. Then we have the sales at break-even point. I hope this is clear. Variable cost per unit. So this is how we determine our contribution margin ratio. This ratio is a very important ratio because it helps us determine our break-even point. So our break-even point, all right, allow me to erase this. If you have any question as we proceed, just raise it up. Our break-even point is equals to fixed cost over contribution margin. So this is equals to our fixed cost was 40 over 10. That gives us 4,000. These are the units. 4,000 units. Correct? 4,000 units. Now we need to determine our sales in sales. So it's 4,000. So sales, break-even point in sales, break-even point sales is equals to 4,000. 4,000 times 20. 20 is the selling price. It will give us 80,000. 80,000 is our sales break-even point. That's our sales break-even point. Okay, $8,000. Now, the other one was the margin of safety. So margin of safety will our margin of safety, our margin margin of safety is equals to sales minus break-even point sales. So our sales, we've been told we sell 80,000 units. So it's 8,000 times 20, our selling price, minus 8,000. 80,000 is our breaking point in sales. So this is 16, 160,000, 160,000, right? Minus 80 gives us 80. So our margin of safety is 80,000. $8,000, so which means this is the range between our maximum sales and the break-even point. So the difference between the break-even point of sales and the maximum sales that we make is our margin of safety. So within that period, that's when we can probably reduce our selling price so that we sell more and all that, if we have to increase our sales, and still we shall be making profits. Any questions on illustration 1? Any questions? Any questions or comments? Anybody is allowed? Just bring up before we go to the next illustration. Hope that is clear. So so you can see our variable cost per unit is the addition of direct labor, variable overheads plus direct material, which gives us 10. Then our contribution margin is selling price minus variable costs, which is that 10. Contribution ratio is 10/20 times 100, which is 50%. Then our break-even point is fixed cost over contribution margin, and this 4 units. So times 20, you get our sales break-even point. Margin of safety is the distance between the break-even point and total output produced. So margin of safety is equal to sales minus break-even point. So this is 8,000 times 20, which is our selling price, minus 80, it will give us 80,000 as our margin of safety. Illustration 2. Okay. A company operating in leisure and entertainment industry is examining the viability of having a concert in Addis Ababa. Estimated fixed costs. So our fixed costs are 60,000. This includes the fees paid to performers, the hire of the venue, and advertising costs. Variable costs consist of the cost of a pre-packed buffet that will be provided by a firm of caterers at a price of $10 per ticket sold. The proposed price for the sale of a ticket is 20. So the selling price of the ticket is $20. So the management have requested you to provide the following information: the number of tickets that must be sold to break even, so the break even point, how many tickets must be sold to earn $30,000 target profit, so target profit of $30, and then what profit would result if 8,000 tickets were sold? What would be the profit? Okay, and then now, what selling price would have to be charged to give a profit of 30? Now, selling price to give profit of $30 on sales of 80, on sales of 8,000 tickets. All right, so we know the sales ticket number of tickets that were sold. We know the profit, but we don't know the selling price. So we need to determine the selling price. So fixed cost of 60 and variable cost of 10 per ticket. So the fixed cost remains the same, and the variable cost is 10 per ticket, which is we already have there. Now number 5, how many additional tickets must be sold to cover the extra cost of television advertising of 8,000? So these are additional costs. These are additional costs. So let's go step by step. The number of tickets that must be sold to break even. Okay, so let's share the new screen. Okay, so break-even point is equal to fixed cost over the contribution margin. So our contribution margin is equals to selling price minus variable cost. So selling price is 20 per ticket. Our variable cost is 10, which will give us 10. So our break-even point is equals to our fixed cost is 60,000 over 10, which is 6,000. So 6,000 units is our break-even point. So you can also get this in dollars by multiplying by the selling price, so that you get $120,000. But we've been asked to get the break-even point. The number of tickets that must be sold to break even, which is 6,000. Then how many tickets must be sold to earn $30,000 target profit? All right, $30,000 target profit. if you are free to ask any question as we continue, all right? If you have any problem following somewhere, please raise it up so that we don't leave anybody behind. Okay, our target profit. Our target profit is equals to 30. So which means to make this profit, we must sell over and above the break-even point. So our break-even point is 6,000 units. Okay, so if you are to, how many tickets must be sold to earn, so the number of tickets that must be sold to earn $30,000. Can you see units to be sold to obtain $30,000? We have the fixed cost plus target profit. So the fixed cost is 60,000. Our target profit is 30. So that will give us 90 divided by contribution per unit. So actually, this is the formula for that. Fixed cost plus target profit divided by contribution margin. So this is how we determine our sales. Target profit sales. So sales so our fixed cost is 60 plus 30 over 10. And this will give us 9,000 units. So this is the formula that we use. Our target sales to give us a target profit of 30. Then you just take fixed cost plus the target profit over contribution margin. You can call this one target sales. Any question on this? Okay. Now, what profit would result if 8,000 tickets were sold? So 8,000 tickets that were sold The total contribution from the sale of 8,000 tickets is 8,000. That is 8,000 times 10. 10 is the contribution. So to ascertain the profit, we deduct the fixed cost of 60, giving us a profit of 20. Okay, so total contribution. So our total contribution is 8,000. Okay, 8,000 is our number of tickets. So you can as well take 8,000 multiplied by 20, which is 160, and then you less the variable cost. The variable cost is 10 times 80, so you still get 80. So it's the same thing. You can do directly by just determining the total contribution if you sell the 8,000 tickets. Then now we are asked to determine the profit. So profit is just the 8,000 less the fixed cost, all right? Because profit is actually revenue minus total sales. I mean total sales minus total costs. So profit, in other words, what you're saying, profit equals total sales minus total costs. And total cost is variable cost plus fixed cost. So our total sales, our contribution, which is now we've taken care of sales and variable cost. So it gives us our, or, you know, you can also take note of this, or contribution margin, total contribution margin minus fixed cost. So this is equals to 8,000 minus our fixed cost is 60,000, which will give us 20,000. So 20,000 is our profit. 20,000. Any question on that? As I said, as we continue, if you have question, just put across. Are we together? Can I hear somebody say yes?
Yes.
Yes, Doctor.
Good. So that is number 3. Number 4.
Question number 3.
Price. Yeah?
Doctor, I have a question on number 3.
Good, yes.
Any sales beyond the break-even quantity,
yes.
That means beyond 6,000 is a profit.
Yes.
Then we are asked how much is the profit if 8,000 tickets are sold?
Yes.
So the number of tickets beyond the contribution or the break-even point is 2,000.
Yes.
That is
Yes.
8,000
Yes.
minus 6,000.
Yes.
If you multiply this 2,000, the excess one, by the selling price, we can get the profit.
What will be the profit?
Yeah, I think so.
What will be
2,000
the
times selling price is 20, 2,000 times 20 will be, I think, 40,000.
Yes. It will not be the same. Because the extra 2,000, you are not taking care of cost. There's a cost incurred to produce them.
Yeah.
So the contribution margin takes care of variable costs, but fixed costs are fixed. Okay, that's why you have to use the contribution margin or get the 8,000 times the 20, we get 160 minus total variable cost, which is 10 times 8, giving us 80, which is 80, isn't it? So 160 minus 80 is 80, less fixed cost. Fixed cost, those ones do not change, so they remain fixed. So 80 minus 60, so you get 20. Yeah.
Okay.
But instead of going like that, you can as well use the contribution margin way or approach where it has already taken care of the variable cost, isn't it? So you just take the contribution margin, all right, the units, I mean the contribution margin times the number of units, right? You get that and less the fixed cost, because that one will have taken care of the variable cost.
Thank you.
Yes. Any other question, concern? Good. So we continue to number 4. What selling price would have to be charged to give a profit of 30,000 on sales of 8,000 tickets, fixed cost the same and variable cost the same? So we know the profit, we know the number of tickets, so we want to determine the selling price. This is so you see, these are things that decisions that you are supposed to make as manager, isn't it? So you have just to play around with these formulas and come up with a suggestive answer to, or a price for that matter in this case, so that it can be charged for the, or can be charged for the products, so that you achieve your targets. So selling price to be charged to show a profit of 30,000 on sales of 8,000 tickets. So required revenue to obtain profit of that is equals total variable cost plus fixed cost plus target profit. All right, so our total variable cost is that, plus fixed cost is 60, plus target profit, which is 70. So selling price per ticket is, that is the 170, the sales divided by the units to be sold, and you get your selling price. So we can do that again here. So total sales is equals to fixed cost plus variable cost plus target profit. So our fixed cost is is 60,000 plus variable cost is 8,000 units and 10 for each. So it is 8,000 units times 10 plus target profit. Target profit is 30. So this will give us 60 plus 80 plus 30. This is 170. 170,000. So this is our sales. Our sales. We know the number of units. Can we get now the selling price? So our selling price is equal to target sales. Target sales. Target sales over target units. So this is 170. 170,000 divided by 8,000 units. And this gives us 21,000. 21.
21.25.
25.
Yes.
So this is our selling price per unit. So we should sell our products at 21 and 25 to achieve our target of $30,000 in terms of profit. Okay. So you can see these are decisions that you have to make, but you have to have a way of getting those answers. So this is how you go about it. Any question on this? Number 4. Okay, no question. So we proceed to number 5. How many additional tickets must be sold to cover the extra cost of television advertising of 8,000? So we are going to incur additional fixed cost of 8,000 because we are told advertising cost is one of the fixed costs from a story given here. Because we are told 60,000, this includes the fees paid to performers, the hire of the venue, and advertising costs. Okay, so this is additional fixed cost. So how do we go about that? All right, additional sales volume to meet 8,000 additional fixed advertisement charges. So additional sales volume is equals to additional fixed cost plus, divided by contribution margin per unit. All right, so additional sales volume is equals to additional fixed cost divided by contribution margin per unit. So additional is equals to additional additional fixed cost over contribution margin. So and this is equals to 8,000. 8,000 is the additional fixed cost. Our contribution margin is 10, which will give us 800 units. Units. So we can test this and see whether we. So we shall have 8,800 units times selling price, which will give us, or we can use the contribution. Let's use the contribution, which is 10. The contribution margin, which is 10, 8,800 times 10, which is 88,000. 88,000. So 88,000, you less fixed cost of 8,000. No, 68. It will give us a profit of 20,000. So you can see that. Okay. So it's 8,800 units. The additional whatever. Any question? Okay. Illustration 3. A company makes a single product with a sales price of $10. So selling price is 10, variable cost per unit is 6, and fixed cost is 60,000. Calculate the number of units to break even, sales at break-even point, contribution sales ratio, what number of units will need to be sold to achieve a profit of 20,000, what level of sales will achieve a profit of 20,000 per annum. Because of increasing costs, the variable cost is expected to rise to 6.5 per unit and fixed cost to 70 per unit per annum. If the selling price cannot be increased, what will be the number of units required to maintain profit of 20 per annum? And then G, if the taxation rate is 40%, how many units will need to be sold to make after-tax profit of 20,000 per annum? Okay, so you see, we are dealing with targets. We are determining what we need to do so that we achieve those targets. And that's why I said this works hand in hand with the budgets, because the budgets set the targets and they give the standards under which we have to achieve. So by computing this, it helps us in determining or making decisions of what we need to do so that we achieve our targets. So number of units to break even. Okay, so break even point is equals to, these are units, fixed cost over contribution margin. And this is equals to, our fixed cost is 60. Our contribution margin is 10 minus 6. 10 minus 6. So this is 4. 60 over 4 is what? 60,000. Divide by 4, 15,000, isn't it? So
Yes.
15,000 units. 15,000 units. Okay, so that is 15,000 units. Then you are asked to give in sales. So break-even point in sales or volume is equals to 15,000 times
10.
10. 10 is our selling price, so it will give us 150,000. Yes. It will give us 150,000. Okay, I think that is direct, more direct than. So sales at break-even point, contribution sales ratio. Contribution sales ratio. Contribution margin ratio is equals to contribution margin over selling price. So this is equals to 4 over 10, and this is equals to 0.4, which is equals to 40%, isn't it? If you multiply by 100, it's 40%.
Yes.
40%. I hope those ones are direct. Those ones are direct. So D, what number of units will need to be sold to achieve a profit of 20,000? To achieve a profit of 20,000. So target profit of 20. So our target profit is equal to fixed cost plus target profit over contribution margin. What number of units? So we are looking for the units.
16.
Okay. So that will be 60
Top.
plus 20 over
4.
So that gives us 8 divided by 4,
Is 20.
which is 20.
Yeah. 20,000.
20,000. So these are units.
Yes.
Units. So if we sell 20,000 units, we'll be able to achieve a profit of 20,000. Any question? I think that is direct also. So let's see. Now, what level of sales will achieve a profit of 20,000 per annum? Sales. So sales for target profit is equals to the 20 units times the selling price, which is 200. Actually, so sales units times selling price, which is equals to 20,000 units times 10, which would give us 200,000. So these are dollars. Now the target profit, since the profit is the same, and we have realized that we need to make 20,000 units, so we just multiply the 20,000 units times the selling price to get our total sales to achieve a profit of 20,000. Okay, number F. Because of increasing costs, the variable cost is expected to rise to that per unit, fixed cost to that per unit per annum. If the selling price cannot be increased, what will be the number of units required to maintain a profit of 20,000? 20,000 per annum. So this is a case where variable costs are changing and fixed costs are changing. So we have to determine our new contribution margin because the variable costs have changed. Our selling price remains the same. Okay. And then we have to make our fixed costs have increased to 70, but we still have to make a profit of 20. Okay, so we need to determine our new contribution margin is equals to 10 minus 6.5, which is 3.5. I hope I'm right.
Yes.
3.5. So new contribution margin is 3.5. New fixed cost is equals to 70. So our target profit is equals to 70 plus 20 over 3.
25.
So that gives us what?
25,740.
That will be 50 divided by 3.5.
Yeah.
Huh?
25,000. Yes.
20,000?
25,714.
25,740.
Yes.
Oh, sorry, it's 90. Okay, I was thinking it's 70. It's 90. 90 divided by 3.5. Yes, you're right. 25,000.
740.
And 14
units.
So this is what we need to sell to make a target 20,000 in terms of profit. When our variable costs increase, and then our fixed costs also have increased. So we need to make sales of that units. Any question? Hope that is clear. If the taxation rate is 40%, how many units will need to be sold to make a profit after tax of 20,000 per annum? Okay. Yeah. These are also decisions that you can make because you know the tax in advance And you can also want to achieve the net profit after tax in advance, all right, or to target. So how do you go about that? Eh? So a number of units for target profit after tax is, all right, 60 plus the target profit times the tax okay, target profit after tax. Of 20. Now we know to determine our sales units, when we want to achieve some target profit, is just a fixed cost. So it's fixed cost plus target profit multiplied by 1 minus T. Now T is the tax. T is the tax rate, all right? T is the tax rate. TP is the target profit. FC is the fixed cost, then over contribution margin. So fixed cost was 60,000. Target profit is 20. 20,000 times our tax rate is 0.4 or 40%. Over contribution margin was 40. Sorry, 4.
4.
Yeah. So this gives us who?
23,333.
So you multiply the 20 times 0.6 first before you add. All right? Make sure you do that before you add. 1 minus 0.4 is 0.6. So you get to your 12. 12 plus 60 is 72. So it's 72,000 divided by 4. Am I right? Huh? 20,000 times 0.6, 12,000 plus 60, 72,000 divided by 4. 18,000? Wait a minute.
Yes, doctor.
It's 18,000.
Yes.
60 plus 20 into 1 divided by 4. Why is 23? It's not. Okay, I see. It is there's a mistake somewhere. This is This is supposed to be division. You divide, not multiply. So it's 20 divided by 0.6. That is 33.333 plus 60. That's 93.333 divided by 4. Yeah, it's 23.33. 23.33.
It's 48.
Huh?
Is that 40?
You're asking a question? Somebody asking a question? So this is not, it's supposed to be 93.33. $93.333. So many threes. Okay, so it should give you 23,
Important. Yeah.
333 units, not a point. 23,333 units. That is what you need to sell to make a profit after tax profit of 20,000. So you need to sell 23,333 units. Any question? Okay, so you just need to note that this is divided by target profit divided by 1 minus T. So this is a very important formula if you have to analyze in relation to the tax, right? So you have to work out this first before you add this, and then you divide by the contribution margin. That was illustration 3. Illustration 4. PE Limited produces and sells 2 products, P and E. Budget prepared for next 6 months. Gives the following information. So product selling price is that for P and for E. The variable cost per unit is that for P and E. Then common fixed cost for the forthcoming 6 months is that. So required, in respect to the forthcoming 6 months, state what the break-even point in sales will be and the number of each product this figure represents if the 2 products are sold in the ratio of 4 to 3. The ratio of 4 to 3. State the break-even point in sales and the number of products this figure represents. If the sales mix changes to 4P, this is E, 4 to 4 actually. Ignore fractions in products. Now, state what the break-even point in sales will be if the number of each unit is produced. The sales break-even point in sales will be, and the number of each product this figure represents if the two products are so in the ratio of that. So the ratio of that. So you need to determine the contribution margin per unit, which is the selling price minus the variable cost. And then you need also to get the weights, which you've been told is 3 to 2. So our total contribution per group of 7, that is this plus that is 7. So you multiply this, you get 20, get 6, so total is 26. Now break-even combined is fixed cost over contribution, which is fixed cost is, we are told, is 561 divided by contribution, which is 30 units. Okay, break-even sales is 21,600 times 4 times 10, and then 21,600 times 3 times 12, which will give us that. Sales for product P is equals to 21. Okay. All right, so we can use this, we can explain this using our okay, P E 5. Now selling price is 10, and this one is 12. Variable cost is 5. This is 10. Okay. Now fixed cost. Now this is a case of a mixed product. You know, there are more than one product that are being produced and sold. Now, we have been told we have P, there are products P and E. Now, selling price for P is 10, for E is 12, and then our variable cost for P is 5, then for E is
10.
what? 10.
Yes.
Is it 10? 10.
Yes.
Okay, so our contribution margin is the difference, which is 5. This is 2.
Yeah.
Okay. All right. So our weights, we've been told that the first case is where we have 3 to 4. Is it 4 to 3 or 3 to 4?
Yeah, it's 4 to 3.
4 to 3. Okay.
Yes.
Thank you. 4 to 3. 4 to 3. Four to 3. So that's our weight. So if you multiply the contribution margin by the weight, this times this you get 20. And this times this you get 6. So which will give us a combined contribution of 26. 26. That's our combined contribution. So so break-even point, we know break-even point is equals to fixed cost over contribution margin. So this is equals to 561 600 over 26, which will give us 21,600. 21,600. Is somebody writing this from another end?
Hey.
Huh? 21,600. Okay. So 21,600. So these are now the units we are that we need to sell to break even. So how much of the P shall we sell? So our sales, our break even point in sales will be our selling price for that is the units times selling price is 10. All right. Times the weight. Okay. We've been told our weight is for first case is 4. All right. So so times 4 plus 21
100.
times 12 times 3. So what does that give us? This is equals to 864,000 plus 21,600 times 12 times 3, 7. 7,600. So this will give us 64,600. So that is our sales if we have to go by this proportion of sales. So using this, we can, the 864 represents the P and the 77600 represents the E. The sales from E and the sales from P. The sales from P and the sales from E. So that is how we determine our mixed product in terms of break-even point. Okay, so for sales for P will be this, and for E will be that. Any question? State the break-even point in sales and the number of products this figure represents if the sales mix changes to that. So it changes to 4 to 4. So we just need to follow the same procedure. But now using 4 so that our weights here, okay, that remains 4. So this is 20. This is 8. This is 28. Our combined contribution is 28. So our break-even point will be 60, which is the fixed cost, divided by no, sorry, it's not 60.
It's not 60. 561,000.
561,000. Thank you. So 561,600 divided by 28, you get your 20. $0.57. Am I right?
So 20,557.
This is supposed to be 561,600. Eh?
Yes.
This 600.
Yeah.
600. I don't know why I omitted the 600. Yeah. But will it give us 661? Let me see. 561,600 divided by 26. Yeah, this one is correct. Though this one is supposed to be 6. So that one is correct. But this one, if you take 561,600 divided by 28, it should give you 20,057.
20,000. Yes.
20,057 are not. So this one is wrong. 20,057. 20,057. Okay, so our sales, our break-even sales is equals to 20,057 times selling price, which is 10 times 4, all right, plus 57 times 12 times 4. Okay, so that will give us 25,7 times 40. 802,280. Those are sales for P plus 20,057 times 12 times 4. 926. Sorry, 962.
62.
962, yes, thank you.
962. Yes.
962 7
36.
36. So when you add the 2,
Yes.
what do you get? When you add the 2,
1 billion.
minus 62. 17 65
1 765
0 16.
016.
Yes.
0
So that's break-even sales to achieve that. Now, the other one was 16. This one is 17. So if you are a manager and you have to make a decision of which mix is the appropriate one, which mix do you go for? This one or the first one? Huh? Who can tell us? This is 1763, and here is 1641. Which one do you go for? Which mix would you go for? Is it 4 to 3 or 4 to 4? I think I should go for 4 to 3. 4 to 3 1. Do you know why?
Yes.
Why? Who can tell us why? Why do you go for 4 to 3 and not 4 to 4?
Because you don't have to sell a lot.
Huh?
In 44, you're taking more sales than in 46.
You make more sales.
You
You go for 4. So the earlier you achieve your break-even point, the better for you. So if you can sell 16 to break-even point, then that is the best point because it's the lower. than selling the 17. You know, these are factors that are sometimes interfered from external sources. So if you can, the earlier you can achieve your break-even point, the better. So 1641 is the best option because you'll break even your sales earlier than if you are to go for this option, because this one you will have to make more sales for you to recover your costs. Okay. Yeah. So the first combination is okay. So you can carry out sensitivity analysis, different options, different combinations or weights, and see the outcome. And then now you can select the one that is the best that the organization can adopt. Okay. So this is how we play around with the mixed products, where you have more than one product that you're selling. You can decide the weights and by doing a sensitivity analysis, testing all the weights and seeing which one is viable, isn't it? So that the one that will give you the earlier opportunity to recover your break-even costs, then that is the best option to go for. Any question? So those are some of the illustrations I had prepared, and I said after this I'll give you some assignment, which will now crown the whole thing. Huh? The assignment I'm going to give you is assignment 3, and it has some components of variance analysis and sensitivity CVP analysis. So I think those are the areas that we have not tested on, and it's good to also do something from them. So one question is coming from variance analysis, and another question is from the CVP analysis. So please try to do this, and so that you can be up to date with what is expected of you in terms of this course. Otherwise, if there are any questions, please put them across so that we see how we can address them. Yes. Oh, yeah. We are. This is our last topic.
Oh, okay.
This is our last topic, and I'm saying I'm going to send you an assignment, which you're going to do the last one, so that we crown it up. And I said I will send you the assignment tomorrow or before tomorrow. Let me send you tomorrow. Then we can go. You can go do it, and then next time we meet, probably you should have submitted the assignment, and then now we shall go through it, just as a revision, and then plus any other question that you may have in terms of revision.
Okay, thank you.
Yes. Any other comment?
It is individual or group assignment?
I was told the last time that you've decided to do you have decided to do group. So I'll be sending through Morges, so that he will share to you the respective groups so that you work on them and then submit probably before next weekend. Because next weekend will be our last class.
So we don't have class tomorrow?
Tomorrow, I want you to use the tomorrow to do the assignment. Okay?
Okay, thanks. That is a good option, Doctor.
Yes.
We would
Tomorrow,
like to say thank you.
Use the assignment, use the time to do the assignment, And then make sure you submit before next weekend, because next weekend we shall now go through assignment revision, plus any other question. You may also share a question probably in advance if you have any, so that I can go through it in readiness for next weekend's class, which will be our last class.
Good.
Any other question, comment? Otherwise, thank you for turning up, and then hope to see you next weekend. And God bless. Thank you.
በትምህርት ከፍ ብሎ መብረር ይቻላል። ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ከከፍተኛ ትምህርት አግባብነትና ጥራት ኤጀንሲ ሙሉ ዕውቅናን ባገኘንባቸው በማስተርስ ዲግሪ ኤምቢኤ በስትራቴጂክ ማኔጅመንት፣ ኤምቢኤ በባንኪንግ እና ፋይናንስ፣ ኤምቢኤ በቢዝነስ ሊደርሺፕ፣ ኤምቢኤ በሪስክና ኢንሹራንስ፣ ኤምኤስሲ በኢንተርናሽናል ትሬድ እና ኢኮኖሚክስ ዘርፎች በእውቀት ለመቅረጽ የበቁ ፕሮፌሰሮቻችን አረንጓዴ መብራታቸውን አብርተዋል። በነገራችን ላይ በኬንያ ሀገር ከሚገኙ ስመጥር ዩኒቨርሲቲዎች በሚመጡ ፕሮፌሰሮች የትኩረት መስክ ትምህርቶቹ መሰጠታቸው ልዩ ያደርገናል። በምርጥ የትምህርት ስርዓት የተገነባው ናሽናል አቪዬሽን ኮሌጅ በመጀመሪያ ዲግሪ በአቪዬሽን ማኔጅመንት፣ በሆቴል ማኔጅመንት፣ በአካውንቲንግ እና ፋይናንስ፣ በማርኬቲንግ ማኔጅመንት አስተማማኝ ትምህርት ይገቢውና ራስዎንና ሀገሮን ይለውጡ። አድራሻ 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ። ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ህልሞን እውን ያደርጋል።